All right, what's up, everybody? Hope you guys are doing well. First official, excuse me, and here. There we go. So yeah, hope everyone's doing well. Anyone here in the chat so far? Anyone here? All right, we're live. Yo, what's up? How you guys doing? How's everyone feeling this evening? How's the time work for everyone? Is this a good time? Or do you guys prefer something else for Thursday? What do you think? All right, sweet. So I don't know how many people are watching right now. I'm sure people will show up, maybe as things kind of creep together. But whole purpose, uh, oh, nice, perfect, perfect timing. Good. Whole objective, right, of this, try to answer basically any questions you guys have. Anything as specific as like I don't know, what you want to do for entries, technique specifics you guys might have, whatever it might be. So, um, really like the way to do this is start firing away some questions, kind of figure out the vibe that everyone's going for, and then we can build it out from there. There's no real set agenda, no specific time limit, albeit probably not going to do 2 or 3 hours here, but yeah, happy to start answering some questions. So who's got the first one? Any questions? Who's got it? Who's got the first one? All right. Well, all right. Electric Outcast, you were the first person to drop a message here today. How's the trading been going this week? What are you stuck on? Can we make AI trading bots? You for sure could make one. Most prop firms probably won't allow them at the moment, but if you wanted to deploy one with personal capital, yes, absolutely. Um, yeah, it could be something there, but yeah, like I'd be a little bit careful with the AI bots for now. Like I think the technology is good, but we're probably still 3 or 4 cycles away from it being anything that you can actually code up in specific trading edge. I think AI at the moment or the bots, they're probably best for like creating indicators or back testing strategies or looking at various ideas within that context. I don't think that the technology there, at least from a retail perspective, quite there to fully automate trading. All right, so Mike's got another question here. The 1K daily loss limit on a 50K account too high? I would say yes, Mike. Generally, I kind of want to be keeping my max loss per day to be about 1% of my account or max 10% of my total drawdown. Those would be kind of the two criteria or two benchmarks that I would assess. So if you're kind of pushing that 2% and 20% of drawdown with a loss, or 50% of your drawdown with a max loss day, that's probably too high. Makes it very challenging to be able to survive a 2 or 3 day losing streak, which is very, very reasonable, right? Or very possible inside your trading. So I would think for sure, I would either think about building up a little bit more drawdown, trading with a larger account, or sizing down. All right. How do I minimize getting my stop losses rejected? So, stop losses rejected, they generally occur when you submit your price when it is below the current stop loss price. So, the stop loss gets rejected because you got executed at a price different than that. If it's something that's happening consistently, then it's an issue with your broker or your brokerage, especially if you're confident that you're getting your fills at above your stop loss price. Okay, so I'd love to see how you set your stop loss when you are pyramiding. So here, so let's say that I was in the trade, right? A market order. Actually, put up a stop loss here first. So we'll say a stop loss of yeah, just 2057. Just keep it simple, right? So I don't have to complicate things here too much. So I could see my stop loss is right 2057. We'll go shorter time frame to make it look more dramatic. If I were to right, so I'm long. So if I were to go long again and buy four more contracts, right? Now I have that. And I go into my position. My stop loss price here is still 25,057.25. What I would then do, right, is go in here, click that pencil, or however you modify your position, and change that to be whatever stop loss price I wanted. So if I then change that now to 65, right, I would have that risk accounted for inside my position. And I would theoretically get stopped out, or should get stopped out, if it does end up filling or hitting that price. That makes sense? Cool. All right. So entry techniques. I mean, look, this is the one thing I think people are constantly overthinking, right, guys? Like I've said it before, and I will continue to say it again. Like my objective when I am entering a position is I'm trying to click it basically when I feel calm emotionally, right? So, as you see price action moving, or as it's pulling into your entry zone, if it's like trying to lure you in into placing a trade as if it's the ring of power, right? Like in Lord of the Rings, where Frodo like constantly wants to put the ring on. If it's making you feel like that, then probably don't want to be entering a position. So fundamentally, once price action is inside my entry zone, I'm listening to that intuition, right? That part is art, not science. So I'm looking for the moment, right, or the feeling of calm or clarity or chill, right, however you want to describe it. And then I'm making sure that I set up my execution process so that it is easy to be green. So do an example here, or easy for me to get a good entry, I should say. So let's say that I had a trade that looked something like this, right? And we had a stop loss set at 074. So first thing, right? Type in stop loss price 074. Cool. And then would draw up my reference price, right? So reference price generally about 10 points away from my stop loss price. So 74 would mean that my reference price is 84. What I would then go in here, right, is fill in the blue line here as my price, and then wait and watch for this to be below 25,084. So obviously we're not getting a super volatile overnight market, so this might take a little bit of time here, but this is all I'm doing. Once it then pulls in, let's say 79, I take a deep breath, focus on my posture, and if I feel calm, that's when I'm going to click submit, right? When I'm in the stream, or when I'm talking about the trade in the stream, the language that I'm using, right, is that like I'm watching here, right? Or I'm like gentle, gentle. Like I'm using language along those lines. So here, right now, price is 82. So let's see. If I were to click now, right, I got a fill. My price was at 84. My fill price was 83.75. So I clicked when it was below my price, right? Ensuring that I got in execution. Price action moved into my entry zone there calmly. And then I was happy to get in. The thing that most people, I think, are overcomplicating here, right, is they are overthinking what they are considering to be a good entry. From my own personal perspective, right, a good entry is better than the reference price. A bad entry is worse than the reference price, right? So if I clicked submit and my fill was 87, but my reference price was set at 84, then I got a really bad fill on that execution. And I probably did something sloppy in my entry technique and probably wasn't feeling that chill kind of feeling, right? So all I'm doing is as I'm waiting for price action to pull into my zone, I'm looking to try to click submit when I feel that moment of control, right? Where I feel like I have no choice but to click the button. And that confidence or that feeling doesn't happen because someone told me to click the button, because I'm accountable to myself over why I'm making that decision. I'm making that decision from a starting point of calm, and if I'm wrong, well, I'm pretty happy to risk 780 bucks on that trade. Or if I'm not, then maybe I shouldn't have placed it. And so I'm happy to just accept those risks. A big thing about feeling confident with your entries is about feeling confident in your risk management, right? If a losing trade doesn't set you over the top or doesn't create that tilting feeling, then it's a lot easier, right, to not feel anxious about your entry because you're happy with the math behind your execution. Whereas if you're not happy with the number that you're risking and then you're entering that trade, even 5 seconds or 30 seconds or 2 minutes of drawdown can often feel like a very confidence crushing feeling, right? And then create environments where you're just compounding mistakes. So, um, again, right, if I were to repeat that process, it's reference price, right, is always 10 points away. Try to be 10 points away from the stop loss low. Once I find my stop loss price, that's the first thing I'm typing in. So in this circumstance, right, 25,080. And then reference price gets set as that blue line. So that's, we'll call it 90. And all I wait, right, is to see price less than 90, and I feel calm. That makes sense? You guys understand the entry techniques? Yeah. I mean, CL, yes, very, very hot. Guys, did that entry explanation make sense, right? Like what we need to understand is it's not a science, right? So like it's not that okay, I see it pull into 86.75 and I click submit, right? It's not that, right? So everyone has to find like their moment of clarity effectively, right? And they need to track and they need to get good at setting up their order window so they make it easy to get filled when they want, right? The biggest issue that people have in getting their executions is things just aren't set up. So then when things are coming in or pulling into your entry zone, you're fumbling and setting up your executions, and then you end up like chasing or doing whatever. So as I'm calling out my stop loss prices when we're in the middle of or looking at setting up a trade, right? I am filling in those numbers as I go, right? So that when something does come together and I have a reference price, everything is already filled in. I just have to type in my price and then I can fire away, right? So you mentioned before that you need to be careful in pyramiding because if it turns the opposite way, you can lose big fast. If you're adjusting your stop loss to below your average price, how can you? So aren't you covering your costs when you bump your stop loss up? Yes, that's why we push the stop loss up above our average entry price. It's on those trades where you pyramid and you deploy a sloppy technique when it then goes against you, right? Those are the ones that will cost you a lot of money. And at least in my own personal experience, right, generally make me feel very, very tilted. So that's why, yeah, pyramiding is all about the operational process of it, where it's execute, adjust stop loss, make sure. So now, right, 88, 88.25. I'm going to see if I can go down a little bit lower. I'm going to be timing my entry here, right? I want to feel calm. Once I feel that calm, I'm trying to click it on the down tick, right? Not on the uptick. So I'm trying to click it as it's moving towards my stop loss, not away from it. If we can get a little baby flush. But look, prices like nicely really settled into that zone. Okay, right? Bought it on the down tick. Fill price was set at 90, right? Average fill price was 88.50. So I, saved myself 15%, right, on that entry. And all of a sudden, right, that 15% ends up probably setting me up, right, to make easier money going forward. So everything with my entries, right, is about trying to create as much asymmetric upside as I can in my decision. And then hopefully, right, I can get a pretty good execution as long as I'm really deliberate in that execution process. Any other questions? I've answered the entry one. Happy to go at some point. What else is on people's minds here? What do we got? Anyone got anything for me? 20 people, and we've had 3 questions. So bigger and faster than expected is again, it's like a relative. It's regarding an emotional reaction, right? So faster than expected is kind of like a synonym for prices making me feel greedy, right? In the same way where we don't want to take our entries if we feel like we're chasing it. We don't want to be in positions where we feel like we're trying to hold on to a rocket ship, right? An emotional rocket ship more than anything, because it compounds decisions. So the overriding standard in any trade is if that a move has triggered some sort of emotional response, you are more likely to make a mistake than you are to make a good trading decision. And once you're up a significant amount of P&L, your risk reward kind of changes on the value of that decision, right? So if I were to like look at this scenario right now, I'd still be risking less than $1,000 from my current PNL, right, to what I want my target to be. So I still have a really effective risk reward for my thesis, and losing that $340, right, and then $680 total probably wouldn't feel that bad. Now, if this number ended up getting to, let's say, 1,300, right, and then it could be a $680 loss. Well, it's no longer a $680 loss at that point, right? It's now a 2K loss. So the risk reward changes of allowing basically my emotions to, or like to override my emotions, right? So early on in a position, the risk reward hasn't changed where I need to be so greedy to justify taking this, or I need to be so paranoid to justify taking this. Facts telling me that things are behaving fine. Maybe not as well as I'd like, but nothing here to be paranoid about. But if price was significantly higher, and all of a sudden now I get that emotional trigger. Well, the cost of losing, yeah, that $1,300, like we described earlier, is greater than the value, right, of the potential stop loss. And so that no longer becomes a really good decision to make. But right now, $20, $40, $300, still well within the realm of reasonable and not faster than I expected. So, more than anything, that's a rule to protect myself from myself, to make sure that I don't get greedy, that I don't overtrade, I don't pyramid into something stupid. And in my experience, the trades that I feel like are going to run forever pretty rarely do. And it's not worth trying to force that sensation. So, by default, right, once I'm in a winning position, I'm evaluating, or basically the risk reward is dynamic. And so I'm evaluating it a little bit differently once I'm in a trade. If it's still small, then I need to trust the thesis. If I've had that follow through and I've had that separation, then the risk of giving away that PNL starts to out or override, right, the desire to necessarily hold on for way more. A good way to visualize this, right, is if like my target was the green line and price was at 25,100, right? I'm now risking, let's say this much, right? 20 points to make an extra 8.5. No longer makes any sense for me to really think about that decision. And it's better off to probably close and take that win than it is to try to squeeze that out and risk giving away everything else. That makes sense, Jeff? Well, Doug, that's the whole purpose of the closing as your P&L is increasing feeling, right? So the whole objective here of closing as your P&L is increasing is to not allow your stop loss to take your win, right? It's that evolution of the risk reward changing. So what your objective to do, or what I have found to generally be more profitable, is once you're in a position and you get that feeling as if you need to protect your trade or you're worried that it's going to reverse on you, that's an emotional reaction, right? So what did we just learn about emotional reactions? When we want to close our positions, we want to get impartial and we want to reset. So instead of seeing, an extra 200, $500,000 evaporate from your P&L, just take the win there. And then if it sets back up, you'll have another opportunity where you can take a stab. Make sense, Doug? So it's like the impulse to protect yourself is the right idea. The way that you're trying to do it is incorrect, right? You're actually giving away more money that way. So when you get that feeling, close your trade instead of trying to hope that you're going to get a big win. Make sense? All right. So next question here, pre-market prep. I'm going to get rid of this. So pre-market wise, I'm looking at three things, right? It'll be effectively how it looks tomorrow morning. So we'll pretend that this is now, what, tomorrow's Wednesday, right? So let's pretend that it's Wednesday. We're looking at Tuesday's candle color, right? So what was Tuesday's candle? Was it green or red? What was Tuesday's volume? And then does today's story tell the same story as Tuesday, right? Or as the previous day. So there's three elements to that, right? There's the candle color, slash shape. There's the volume profile, right, of that candle. And then there's what is price action doing today. That's the three elements that we're looking for in the 3 for 3. So if I were to look at this right now, right, it's a green candle, one. The volume is decreasing, so it's not a point for increasing volume. And then it's a gap up, right? So two out of the three things, yesterday's price action or yesterday's candle color and today's candle color, are telling us the same thing. So we have a 2 out of 3 to the upside, i.e., 2 out of 3 things are bullish, and it's without volume because yesterday's volume was decreasing. So we then know that we have bullish trending markets or weak bullish trending markets that lack volume support. And if we really want to see strong trending price action, we need to get that volume to return and indicate a change in momentum. So the pre-market conditions, right, are always previous day's candle color, previous day's volume, is it increasing or decreasing? Current day's price action, is it higher or lower than when it opened? And if all three things are telling us the same story of strength, so we have a green candle with increasing green volume and then a gap up, we know we've got a strong trend. If we've got 1 out of 3 things, right, we know that we've got kind of non trending action. And then if we have 2 out of 3 things, we know what we're missing, right? We're either missing volume or we're missing today's PA, and we need all these stories to sync up and get consistent. The 3 for 3, I use it a little bit differently now than maybe I used to, right? So back in the day, I used it a lot more aggressively to like filter out specific setups in a direction. But as markets have gotten a little bit more range bound and things have gotten a little bit choppier, that has become less necessary because we're not dealing with a particularly strong trending market. So all it is, or how I use it now, is almost like a scoreboard where I want to see, like if I have a 3 for 3 on NQ, I want to see 3 for 3s or 2 out of 3s with volume, right, on the leading names. So I can kind of have confidence and conviction that the narrative is consistent across the board. Again, I'm looking at three things, right? Previous daily's candle color, previous daily volume, and then today's price action. Is it higher or lower than when it opened overnight? Make sense, Olivia? So here, right, this candle will only be green if the current price is higher than the open, right? And this candle will only be red if the current price is lower than the open. So if the candle is green, it's gapping up, right? If the candle is red, it's gapping down. So it's not, we're not calling it higher than Tuesday's open. It's, is it higher than the open when, 4:15 or whatever time it is? Yes. 3 for 3 indicates that we have trending action, right? Everything is telling us the same bullish direction or the same bearish direction. Yeah, makes sense. All right. Someone asked, what should we be expecting for next week with the futures contract you were talking about? So, great question. You see on my chart here how I have this, and it says we're going from NQH to NQM. So we're gonna keep an eye here, right, on this price. We're gonna type in NQM, here's right, and it's gonna be the June 2026 future. So look at the price here, right? So the price of this June contract is 25,309, where the price of the March contract, right, is 25,092. So we have about a 200-point spread or a 200-point difference, right, between the March contract and the June. So what we're going to see, right, is some discrepancy in prices as we basically still deal with that spread, right? So if you're looking at my chart, right, or you're seeing on my screen, it might say 25, 311, 50, but on your screen, it'll say 25, 091, 50, right? It'll be the same setup, right? It'll be the same quote unquote price action, but the prices themselves will be potentially different because there is a difference in the spread. The contract roll effectively means that we're switching from trading the current contract, which is the March, to trading the June. And so everyone who has a long-term thesis or open positions on the March contract has to switch over to trading the June contract if they want to hold on to their positions. So there's a lot of forced buying and selling, which creates called inconsistent volume signals, right? Where because people are forced to buy and sell, we'll often see periods, right, of really, really tremendous momentum where things look like they should be absolutely incredible, only for price action to then immediately stall out and reverse. And when you pair the just traditional dynamics of a futures roll with the general volatility that we have in the market, we just open up scenarios where it makes it very easy to have very challenging executions. So, like today, for example, we had a couple scenarios where we had pretty nasty fake outs that were quite frustrating to deal with and ended up running really tremendously right in our direction. Like, we would have been green had we not placed a stop loss type thing in a futures role, right? You have a lot of variables that basically introduce environments that make fake outs or traditional fake outs, right? Or shakeouts like we saw today a little bit more prevalent. So, very often, although you get a lot of like signals, a lot of those signals are often false signals because the volume is generated by forced buying and selling, not necessarily by new positions or by adding or closing trades. And that just certainly complicates the ability to do smooth technical analysis. Every quarter, I say I'm not going to trade the futures roll, and yet I still somehow always start the stream up and end up watching. We'll just have to see how effective it is and how quickly that spread tightens. So, as we're watching the March contract, once the volume switches over to the June, that spread will probably be like 100 points, maybe 150. And then as we get closer to the actual roll date, things will start to tighten up a lot more and we'll get back to having that consistency. And then as you separate away from the roll, the difference between the June and the March contract will again continue to separate and we'll get back to having that large spread. But we won't care because we will be trading the forward contract at that point. So from like an execution perspective, it's not going to change too much. Maybe on like the Tuesday or the Monday, or potentially even the like Wednesday, you'll just have to type in NQM, right? Or the June contract code instead of the March contract code, and you'll be fine. We'll be able to trade the new one. The new one will become NQ1, right? So NQ1 is the forward contract. So on Tuesday, the 17th of March, we go from the forward contract being NQH, which is March, being NQM. So it'll automatically be done. But for a couple days there, we might just have to manually type in the ticker instead of NQ. It'll be manually switched over, and it's just the same way you type in any ticker, right? So you just go into the top left-hand corner, you type in NQ, right? And you can just even go futures, and then you just look at June, right? We're moving from March into June, and so just then click that. Make sense? Any other questions here, team? What else you guys got for me here? Got a question? Anyone? No need to be shy, right? This is the moment. Yes, he'll help you set up a trade copier. Yeah, no problem. But it's not that difficult to do. I mean, if you look up some YouTube videos, I'm sure you'll be able to sort it out yourself. Do I just create a new contract? Not quite sure what you mean by that. But let's say that I was entering a position, do proper NQ here, so I get a fill. I would just do 4, right? Or however many I'm buying. And then if I were to buy again, I would just, as if I'm entering a new position, right? It's smart enough to stack them together and to add them together, which is why or how it gives me that average price, right? So again, buy market K87. Now if I buy at 86, right? Now my average fill price is 86.13, right? So it's a little bit different, and that's how you get that average price. Yeah, I mean that's got to be your antivirusing. You're gonna have to put in some sort of exception for it, right? So it's your computer and your software that's blocking it. You're gonna have to add a manual override. Yep, there's lots of copiers, Brian, that allow you to do that. Any other questions here, team? Back up a couple more. Like I can't, Olivia, I can't really provide more technical support than that, unfortunately. Too many variables there. Yeah, Replicanto is not one of the ones, Brian, that will allow you to execute trading view across different prop firms. You'll need a different solution. Trader Sync should allow you to do that. Any other questions here, team? Any other questions? So the market replays in trading view is not a very good tool for that. all you do, Doug, right, is one day you just suck it up and you paper trade all day instead of trying to copy or replicate the DTR trades. And you just do this 100 times, right? All right. And then that stop loss, right? Set your reference price and then wait, execute, right? And just keep going through that process and just constantly just doing that, right? That's the only way you're going to do it, or the only way you're actually going to get better. The other alternative, right? If you don't want to do it during the stream hours, you do it during power hour, right? Last kind of like 90 minutes to an hour of the day. And then from there, right, you'll have a lot of volatility and good momentum where things will move quickly. They'll replicate some of the chaos that maybe you'll be used from the morning or the speed and be able to build it up. But the only way is just start to build that muscle memory and that routine, right? Stop loss, position sizing, reference price, and just build that muscle memory. There unfortunately is no shortcut or faster way to do it than just getting good at doing it. What's my single biggest trade win and loss? Biggest win? I don't know. I've had a couple like six-figure days in that type of range. I don't know. I don't keep score too much or don't like try to keep memory of it too much. Biggest single loss on an individual stock. I also don't know if I have that memory in the top of my mind. What I do say though to people is that, when I first started trading retail and I kind of went through my own like learning curve after trading institutionally, I had like 50K of drawdown in about 2 weeks. So in that period, lots of 5K losses, 10K losses, 7K losses. So, disgustingly big numbers. But generally don't keep a scoreboard like that in my brain or try to keep it 0-0. Um, but yeah, I would say that's probably it. So the number of contracts you're taking, right, is a direct reflection of the stop difference between the stop loss price, right, and the reference price. So if we're gonna go short. So if I'm playing to the downside, right, and my stop loss is at 83 and my reference is at, let's say, 73, right? 10 points. So how much does NQ move a point? Well, it moves $20 a point. If your max risk per trade is $1,000 and your risk is 10 points, and 10 points is worth $200 per contract, you take your 1,000, divide it by 200, and that gives you your max units, right? Or your position size that you should be taking on that trade. We keep our risk to be very, very consistent at the moment, right? We don't do, at least not anymore. We're not doing 12 points on one trade, 20 points on the other, 10 on the other, 5 on the other. I'm sizing everything to be for 10 points of risk. So that number for me is consistent. I risk about $1,000 per trade at the moment. That's what my number is. And so I'm generally buying 5 contracts with 10 points of risk, right? 5 times 20 equals 100, times 10 equals 1,000. Doug, sounds like you have an issue with setting up your executions. And because you're hesitating on your executions, you're missing entries. So you need to start using that ask technique, right? Or that reference price technique, like we mentioned. So yeah, if I'm going short, stop loss here, 82, right? Reference price, 78. So all I wait, right? All I wait, right, is to see a price better than that. So now I got 79, boom, executed. Instant fill because I'm telling the market, fill me at 78, price is at 79, I'm going to get filled, right? So it's just a question of your execution technique and you're not setting it up correctly. So when you're clicking submit, you're not getting filled, right? You're clicking submit as the trade is going in your favor, not as it's moving closer to your stop loss. And so when you click submit, price is above your price and you don't get a fill. Make sense? Any other questions here, team? Okay, final call for questions. Final call. Good, Olivia. We'll see you tomorrow. Come on, guys. Last shout, last chance. All right, guys. Well, have yourselves a great rest of the evening. We'll do another one of these on Thursday, right? We'll do the same thing on Thursday. So it'll be Tuesdays and Thursdays going forward. Hopefully, prop is launched for Thursday. I've got my compliance call tomorrow. Hopefully that goes smooth, and then we're off and running. So it's gonna be an exciting March. Looking forward to it, and hopefully a nice, good trading day for us there tomorrow. Guys, then peace.